Since the start of the year, the Stoxx 600 index, the European equities benchmark, has significantly outperformed the US S&P 500 index. Inflation in Europe has also cooled down and stabilized, with the potential to decline further as the euro strengthens. This represents a rare chance to diversify away from the US mega-cap tech and into high-quality European dividend growers. My name is Billy Huang, and I'm a senior investment analyst at Brompton Funds. For over a decade, investors have been focused heavily on US equities, driven by tech giants and high-growth names. But now, Europe is making a strong comeback, and it's time to pay attention. Since the start of the year, the Stoxx 600 index, the European equities benchmark, has significantly outperformed the US S&P 500 index. This is a sharp reversal from last year when the S&P 500 index delivered approximately 25% total return, whereas Europe only gained about 9%. We have seen an increase in fund flows into Europe due to tariff concerns and a flight to safety away from the US market. Brompton believes this could be the beginning of a structural reallocation for global investors. The macro backdrop, especially the interest rate environment, has become more favorable for Europe. In the first quarter of 2025, Eurozone GDP came in strong at 0.4% growth, while US GDP contracted by 0.3%. Inflation in Europe has also cooled down and stabilized, with the potential to decline further as the euro strengthens. In fact, the ECB, the European Central Bank, has cut its policy rate from 4.5% to 2.15% within a year. We believe the ECB is more flexible to reduce rates as inflationary pressure eases further. We've also seen recovery in bank lending to both households and businesses. We believe government stimulus will unlock Europe's growth potential. Germany recently announced an unprecedented defense and infrastructure spending plan. This package, approved by both houses of parliament, allows defense spending over 1% of GDP to be exempt from the country's debt brake, i.e., their constitutional debt ceiling. This marks a dramatic shift from Germany's traditional fiscal conservatism and is boosting investor confidence, especially in sectors like aerospace and defense. This fiscal pivot will support not only Germany but also the broader European economy in the years ahead. Let's talk valuations. European equities are trading at significant discounts compared to the US. Even after recent gains, valuation metrics remain compelling for European stocks. This represents a rare chance to diversify away from the US mega-cap tech and into high-quality European dividend growers. Many investors' portfolios are concentrated in US equities, a concentration that comes with inherent risks. By increasing exposure to Europe, investors can achieve better diversification and potentially enhance risk-adjusted returns. Brompton offers an actively managed fund called Brompton European Dividend Growth ETF, and the TSX ticker is EDGF. EDGF invests in large-cap dividend-paying European companies. Our portfolio consists of carefully selected high-quality European stocks that tend to outperform the broader market through different economic cycles. These companies have stable businesses, visible growth catalysts, disciplined capital allocation, and a strong track record of returning value to shareholders. We also use a cover call writing strategy to generate additional income and lower the overall portfolio volatility for EDGF. We believe the tide is shifting and Europe has become more pragmatic, which provides structural tailwinds for Europe over the long term. For more information, visit www.bromptongroup.com/Europe now.